So let's have a look at a little bit at the implemented portfolios approach, because this is one area that I guess we've adopted in the last 12, 18 months. Are you able to sort of explain a little bit about how implemented portfolios came about? Because I think that the story is important.
Sure. Yeah, happy to. We turned 10 years old at the start of last month on the 1st of June. Was when we first started managing portfolios, and we grew out of an advice business. The founders of the business I was running an in-house portfolio service there. We started using this managed account technology and license structures and those sorts of things, which was very much in its infancy back in those days. And really the catalyst for us doing that was the frustrations of the way the industry was structured. So you had expensive platforms, master trusts, wrap accounts, those sorts of things. You had expensive managed funds where you didn't actually know what the manager was doing and what they owned. And it was actually quite difficult to do a full cost analysis and figure out exactly what it was you were paying. The technology was nowhere near what it is, of course. So if you're an elite client, you probably got 2 review meetings and maybe a phone call. Otherwise, you got one, and you'd sort of look at a portfolio and look at some research reports and move one to the other and make some recommendations, and then deal with life insurance and everything else as well. And it was really, really a substandard approach, but still quite a prevalent one. So we did some research. We looked at offerings around the world. We spent a bit of time in the US understanding what they were doing well over there. They were further advanced down the ETF path than we were in Australia. We certainly kept hearing that asset allocation was the most important thing to get right. We put together the investment committee. So the same 4 of us that are still on the investment committee today were running that portfolio service more than 10 years ago. There's a lot of stability there as well. And really it was about sort of separating the roles we were talking about before as well, from outsourcing it to someone else and crossing your fingers and hoping they do a good job and finding out in 6 or 12 months that they didn't. So it was really built from us and our background in sitting across the table from an end investor, a mum and dad investor, and knowing what their frustrations were and trying to build something that addressed that. So we get traction and build partnerships with advisors like yourself and a whole bunch of others now, pleasingly, who, again, not that they can't build portfolios, but their time is better spent elsewhere, but also don't want to hand a client's money over and cross their fingers. So the ongoing engagement is really important for us. And as the team has grown, that's the sort of roles have been more defined there as well, where I tend to talk about the bigger picture model portfolio approach. As you know, there's a couple of guys that are always available to talk about individual client circumstances, make some tweaks or some tailoring here and there. Hey, there's a bit more cash coming. What should we do with it? Will we top up over here? Or they'll need a distribution in 3 months' time, so we want to make sure we've got ready cash available. All that individual portfolio customization work is really important there as well. So that's been the pedigree. It was built because of the frustrations within the industry, which ultimately, and to be frank, one of the reasons why the ETF part of this market was slower to adopt is because it's changed a fair bit over the 10 years. But when you go back, kind of 80-90% of the industry was owned or licensed by one of the big 4 banks or AMP. And they had no interest in allowing their much higher fee and margin managed funds to be cannibalized into much cheaper and transparent and efficient exchange traded funds. So that's taken some time to build a foothold here, but it's certainly done that. And yeah, like I say, it's built on partnerships, and it's built on the collaboration and a genuine collaboration between the 3 parties to it. Obviously you and me, but more importantly, your end investors as well.
Yeah, and just on that, look, I guess I grew up in the days where I was thrown in as a young advisor in front of multi-million-dollar portfolios. I think the biggest one we're looking after, I think in my early 20s, was a trust fund of about $50+ million. It was all direct shares. There was very little managed funds in there. And then the banking industry, you're pretty much forced to their approved product list. I remember back when I partly owned a larger practice under the AMP umbrella, pulled over coals for not recommending an AMP product. And I said,
Yeah.
"Look,
Surprise. There'd be a lot of AMP funds on the AMP approved product list.
Yeah.
And look,
there's
sort of
I was just want to sort of explain just on that as well. You know, you were sort of forced a bit, but also your idea around building something that clients were looking for. I guess we also found that, particularly back in the GFC days, there were a couple of issues clients had. Is one that, you know, if we came out to them with a certain review, the recommendations would be different if we'd done it 2 weeks before. And there's really nothing actively going on between, and also leading into the global financial crisis, is everyone thought that their portfolio was being actively managed, and why wasn't money pulled off the table before then? And I guess that's one of the reasons I guess you guys are built for that very reason, is to sort out some of those inefficiencies in a client portfolio that happen in between client meetings.
Yeah. So that's, I mean, it goes a little bit back to the active versus passive debate we were having before. And so the vast bulk of the industry is completely, they call it strategic, but it's passive in terms of the asset allocation. So kind of one of the industry benchmarks, not just here but around the world, we used to talk about a 60-40 portfolio. Yeah. 60% of your portfolio is invested in risky stuff like shares, and 40% in defensive stuff like bonds. Leave it alone, never touch it, come hell or high water. It's a 60-40 portfolio. And then as an investment committee, as an analyst, we spend all of our times debating ANZ versus Westpac or BHP versus Rio, which is less than useful.
Yeah.
So we kind of, and not just us, but a minority of the industry said, well, that's completely the wrong way about looking at it. And so we don't try and pick individual stocks, as we spoke about before. The most important thing to get right is risky versus defensive. And for us in particular, that more dynamic approach to asset allocation is a couple of really important philosophical points within that. If we think a risky asset's likely to give us a really lousy outcome, particularly because it's incredibly overpriced, then I certainly don't want to hold my neutral weight, and I probably don't even want to have a slight tactical underweight to it. If it looks really lousy, get out of it. Get out of it altogether. And we've done that. We've done that a few times. 4 or 5 years ago now, we got out of listed property trusts altogether. We're not in the US at the moment at all, and haven't been for some time, because we think the forward-looking returns there are going to be lousy. We don't hold risky debt at the moment, high yield income, junk bonds, those sorts of things, because there's just not enough compensation for the risk that you're taking on. So they're the really important and consequential decisions. And then we implement those using those efficient building blocks we were talking about before. And that's really quite a different approach to the vast bulk of the industry.
Yeah, and I just wonder, I sort of was just thinking as you were sort of discussing the whole, you know, why Westpac over ANZ debate, I wonder whether the industry has done itself a disservice because people have got sick and tired of, you know, the financial planning industry in certain areas that they're, you know, being pushed into these products that have decided, no, don't want to do that. I'm going to go off and do it myself. And that's where they go with direct shares, and that's where things blow up.
What's the number in the Australian marketplace? It's only 25-30% of people have a financial advisor of any description.
Yeah.
So yeah, absolutely. And equally, that's where the $6 trillion US, 8 or 9 trillion Australian dollars that's come out of those expensive, high turnover, high fee, tax inefficient managed funds, or even brokerage accounts, because I might like ANZ over Westpac this month, but it might be the other way in 3 or 6 months' time, and I'll clip the ticket on another brokerage.
Yeah, anyway. So I guess you sort of covered the investment philosophy a little bit there, but just in simple terms, what is the investment philosophy that you really are known for?
So dynamic asset allocation, get out of the way of expensive assets and bubbles in particular, have the flexibility to go to zero on risky exposures that look awful. So in theory, the portfolio structure allows us to go to 100% cash. It's hard to imagine a circumstance, having just been through a global pandemic, where we would get close to that, but certainly we've exercised that flexibility. Take a long-term view. Don't ask me what the market's going to do tomorrow, next month, next week, next quarter, even next year. I don't know, and I don't need to know. Because to remind that conversation we had earlier in the piece, sentiment and volatility and prices will wobble up and down a lot. Over the long term, there's a lot more stability in what do earnings growth look like and what do dividends look like, and that's where your returns will come from. Really, what's at the foundation of us being able to deliver that successfully is the trust that your clients have in you. So we spoke before about the circumstances and experiences during the GFC. One of the questions that I often used to ask advisors is, how many clients did you lose during the GFC? And the answer is generally 0, 1, maybe 2, and that's about all. So because of the pedigree of where we came from, and we started the business with, there was a time where actually knew all of the clients personally. That's a long way in the past, fortunately, because the business has grown.
Yeah. But
there was that trust there to start with. And so we've been careful about partnering with advisors who understand that piece. And if we can leverage off that trust that you've built with your clients by being a good partner to you and to your end investors, then we will stay the course. We will look through the short-term noise. We will kind of zig when other people zag. And it's sort of, everyone likes to think they're a contrarian. Of course, by definition, they're not. Yeah. And so we genuinely try and not benchmark ourselves to industry or compare ourselves to other funds. Our success criteria is the extent to which your clients meet their lifestyle and cash flow objectives.
Yeah, and I guess that's, as Australians, we tend to have this whole, we've got to compare ourselves all the time. I know we have many conversations with clients, particularly new ones that come in comparing, well, let's look at the returns, when really it should be, once again, I come back to that personal benchmark thing that they should really be looking at, which is really, to me, important. And I guess, one of the questions I tend to ask a lot of people where they've got issues around, I say, look, okay, let's just turn the tide a little bit. If you happen to never, ever beat the market, but you're able to achieve everything that you wanted in life, would you be comfortable with that?
I hope they said yes.
I've never had anyone say no. Because I've actually had a husband and wife sitting there, and I've actually asked it to the husband, who's been the one that's been dominant in the investment space, and there's a grin on the wife's face while he's answering it. Because she's thinking, we don't need to be talking about this, love. Let's get on with the important stuff. So it's quite funny.
Yeah.
So look, is this sort of approach right for everyone though? It is fairly unique, and I guess particularly for us, we like to individualise things a bit because every client's different. They have different needs. No portfolio ever looks the same. Who is it really for, and who is it not right for?
So often that question is couched in terms of size. And the simple answer is we can cover all bases there. Our largest accounts are north of 20 million, and we've got some that are 30, 40, $50,000 as well. So that it's not around portfolio size. Some advisory businesses, have an average of $1.5 million. Some more are kind of in the $400,000, $500,000, $600,000 range. So the flexible portfolio structure means that an advisor can have an ongoing engagement with us. What we find often is that it's more hands-on in the first 3 to 6 months of a transition, either of an advisor's business, but on individual portfolios as well. And importantly, we have the flexibility within the portfolio structure to continue to treat new money differently to old. And that sounds a little weird when you say it out loud for the first time. Yep. So let me explain a little bit. I would say it's one thing to own an asset that is expensive, having bought it at a cheap price. It's another thing entirely to pay the expensive price. So let's say, tipping points charts again, something was in our green cheap band and happily it's performed really, really well. It's crossed into our overpriced band. We will take our target to 0. But the second decision we make is how quickly do we want to get to that target? And it might be as long as 18 or 24 months or even longer, depending on what happens. But because the target's at zero, the new account that you give me to invest next week doesn't pay those expensive prices. Yeah. And that's very different to most of the industry as well, which invests under a structure called a unit trust, where by law, everyone has to line up on exactly the same mix of assets in that fund. Yeah. So we do have quite a bit of variability between accounts that are invested in the same program, either because of that timing and longevity and the two decisions we're making about which target are we getting to and how quickly do we want to get there, but also because of the individual guidance and circumstances, the non-model holdings, the cash, contributions or withdrawals as well. So most of the advisors, don't want to second guess us happily on an ongoing basis, but it's really important that they know when they need to put their hands on the levers, they can, and can pick up the phone and talk to the portfolio management team and make sure there's an individual, customization reflected in a particular client's portfolio for them. So kind of a long-winded way of saying it's a very open, flexible structure. We can hold managed funds, we can hold equities, we can hold ETFs, we can go offshore and buy in 15 or 20 different markets around the world. So if you do want to buy Amazon shares at the crazy prices that they're trading at, just pick up the phone and we can do that. Again, most people are happy to leave the ongoing portfolio management to us. So it's a very open and flexible structure that allows control and also gives transparency as well. I guess they're the sort of the key messages around it. So, as you'd expect me to say, it's the right thing for everyone.
Is it not right for some people?
It's if you want to be a DIYer, then there's no point paying me fees. That's the obvious answer to that one. Yeah.
Yep.
If you want to make all of the decisions, you shouldn't be paying me to make any of that. Yeah.
No, that's right.